There's been a lot of interest in dividend capture strategies for a long time. And there's a lot of literature to point out that you can make money actually through the dividend by buying before, getting an increase of price, which also doesn't go away right when you sell.
All right, joining me will be Alex Morris, CEO of FM Investments, who currently offers 18 ETFs, about $8 billion in assets. They have been a really nice ETF success story, especially when you consider that they didn't launch their first ETF until a little over 3 years ago. So they haven't been around that long, but they're now at that $8 billion in ETF assets. And they're not resting on their laurels. They just launched two very interesting bond ETFs that seek to avoid dividends or the interest from underlying holdings, which are actually other bond ETFs. So in essence, these are highly tax-efficient bond ETFs. And Alex and I are going to walk through those products, and then we'll actually switch gears and spend some time getting into the multi-share class structure, because FM is seeking to launch a mutual fund share class of their existing ETFs. They're trying to go the opposite direction from many other fund companies who are seeking to launch an ETF share class of their existing mutual funds. So we'll discuss why they're doing that and where everything stands here. Now, to start this week, I am joined by Roxanna Islam, head of sector and industry research at VettaFi, who is going to dive into one of the hottest trends in ETFs right now, and that is superstar fund managers. These well-known investment strategists and personalities you see on TV, they're all now getting involved in ETFs, and they're basically leveraging their fame to help compete in the ETF terror dome. And so Roxanna and I are going to look at this from multiple angles, because I certainly have some thoughts here as well. And then we will switch gears and take a quick look at what's not working in the terror dome right now. We'll look at ETF closures, where there are several trends that have become apparent. And so let me now welcome in Roxanna. I've got to tell you, it is so great to see you. Thank you for joining me this week.
Yeah, Nate, it's great to see you in person and do this by video.
I love it. I'm still adjusting to the format, but I think I enjoy it. I like the direction we're heading here. So look, we're going to do sort of a what's hot and what's not in ETFs right now. And as I just mentioned, something that's very hot right now, a big trend we're seeing, is these brand name investment celebrities or colorful personalities, whatever you want to call them. They're all launching ETFs. And I believe your colleague, Kirsten Chang, she calls this entire trend ETFs going Hollywood, which I love that. But Roxanna, I mean, you look at some of the names getting involved here. We have Fundstrat's Tom Lee. He's getting a boatload of publicity right now. Dan Ives in his colorful suits, he launched an ETF. And actually, I don't know if you saw this, he launched a clothing line as well. I just saw that Ron Barron is finally getting into ETF. So he has a big following on Wall Street. And then you add to all of that, there are some other ETFs that aren't directly tied to an investment celebrity, but they're absolutely leveraging the star power of them. So ETFs tracking Warren Buffett and Bill Ackman and on and on. And so to start, I'd love for you to have us or tell us what's going on here. Like why is this now a thing?
Yeah, Nate. Well, this is, I think, a very interesting trend because and I think it falls a little bit under the radar when it comes to some investors because it's not really an investment theme, right? It's more tied to personalities, but we are definitely seeing this become a bigger trend. We're starting to see more of these superstar funds or investment celebrity funds now than we used to. And, to me, I think it comes down to the story that, there are a lot of ETFs out there right now. There's almost 4,500 of them out there, and it's hard to stand out. So, when you have a big personality, a big investment story, I think that's a huge advantage. So, some of the managers you mentioned, like Tom Lee, Dan Ives, Ron Barron, they all have credibility. They all have a following. So putting their name onto an ETF, that's one way to just cut through the clutter and leverage their brand recognition and appeal to investors that way. And I think it also speaks to the efficiency of the ETF wrapper. I mean, there's clear demand from retail investors for these strategies that they can access easily, and wrapping your strategy in an ETF, I think, is an attractive option for managers now.
Yeah, and what's interesting here, and you were alluding to this, it's not just that these celebrity types are launching ETFs. Investors are interested in them as well, right? You look at the Granny Shots ETF from Tom Lee, that's around $2.5 billion in assets. It hasn't been around for even a year yet. I saw that the Dan Ives ETF, that just crossed over $500 million in assets. That just launched in June. So investors are showing real interest here, right?
Yeah, and I think that's an interesting story too, because it's not just these are being launched. Investors are actually wanting these. And if you look at performance, they've actually been pretty good for a lot of the ETFs you mentioned. I mean, if you look at Ives, it's been up about 12% since its launch earlier this year, and Granny's been up 17% year to date. But I don't think it's just performance. I think it's what we discussed earlier. It's that brand and storytelling do matter in ETFs. Take tech or AI, for instance. There's so many of these out there. There's even hidden tech ETFs. A lot of these thematic ETFs are just tech ETFs in disguise. So how do you cut through all that noise? I mean, Dan Ives, for instance, he's someone you see on the news a lot. He's a trusted voice. He's very recognizable, even physically. So in a crowded field, I think attaching to one of these big personalities is something that, seems to resonate with investors, and it's something that's in demand.
As I was thinking about this trend and our conversation here today, I couldn't help but think of Cathie Wood. And I'm curious whether you think Cathie Wood, of course, of ARK Invest, if she sort of set the mold here. And I know she's been around for a while, and I don't believe she was a very well-known commodity when she first got involved with the ETFs years back, like some of these other names that we're talking about today. But she has clearly become a household name. And she's someone who, whenever she says pretty much anything, mainstream media is all over it. So I feel like she fits right into this category. Do you think that she originally started this trend? Like she basically drew the roadmap for everyone?
Yeah, I know. I think you have it right here. I think Cathie Woods is one of the names that comes to me when I think about this sort of theme, because when you think about it, like you said, when she came out back in 2014 with ARKK, I don't think she was really a household name, but she made a bunch of bold bets. She made a bunch of good calls, and then ARKK had some massive success. And, from there, she became one of the most recognizable names in ETFs. And I'd go as far to say that, I don't think it's far-fetched to even say that she's more recognizable than her ETF names themselves. So I think that gives a lot of inspiration to some of these managers, that personality and media presence can help drive flows.
When I think of people like Cathie Wood and Tom Lee and Dan Ives, they all seem to have this knack for getting in front of the media. It's like they have this natural gift of attracting attention, whether that's good or bad attention, right? They have this innate ability to get eyeballs. Do you think that's ultimately the story here? Like if you had to boil it down, the secret sauce is attention. Right? That's how they can overcome things like lack of distribution, being smaller independent issuers, or maybe even higher fees on their ETFs and some of the other products out there. Do you think it's like attention cuts through some of those other disadvantages?
Yeah, I mean, obviously there's investment skill involved, but if you think about it, there's a lot of managers out there with good investment skill. So I think a lot of it does come down to media and their media presence and their visibility. I mean, going back to Cathie Woods, I think you mentioned earlier, every time she makes a call or makes a trade, it becomes headline on the news. So, that sort of a media presence is, hard to come by, but it's very effective when you are launching and maintaining a product. And it does help, I think, overcome some of those traditional shortcomings that you mentioned. Like they're not going to have the same sort of distribution that Vanguard or BlackRock does. Maybe fees are a little bit higher for all of these. I mean, a lot of the funds that we just talked about today, they have fees closer to that. To 75 basis points. But attention, I think, ultimately drives awareness and flows. Investors, they want access to these skills these managers have. And, the media is one way that they push their presence, that they become more visible to the public eye.
And I would say it's not just mainstream media, it's social media as well. I think, as you know, I like to have way too much fun out on X or Twitter. And you'll see Tom Lee and Kathy Wood and Dan Ives. They have huge followings. They generate a lot of eyeballs there. And so I do think, even though social media has clearly been around for a long time, they're all leveraging that very effectively in addition to mainstream media. And I do think that helps cut through the noise out there. When you talk about there being over 4,400 ETFs on the market, it's tough to stand out. And certainly one way to do it is through the media and through social media, and they're doing it all very effectively. In terms of the ETFs themselves, and we don't need to go through all of these quote unquote celebrity ETFs that are out there, but I do think it's important to highlight that there are some different approaches, whether that be active ETFs that are directly managed by these celebrities, or there are ETFs that track 13F filings. Do you want to talk a little bit about that and maybe some of the pros and cons, again, just at a high level?
Yeah, so some of the ones that we talked about today, the ones from Tom Lee, from Dan Ives, from Kathy Wood, those are ones that are directly associated with the specific strategist. So, obviously the big advantage there is that you're getting the most current thinking from a skilled manager. A disadvantage is, maybe you're paying a little bit more for personality. These do come with higher fees. They're all around 75 basis points. There's sometimes concentration risk. The other category that we didn't really touch on is the, you can call them 13F mimics. They're ETFs that they sort of copy the disclosed holdings from a 13F filing, and then they use that as an ETF. So, for example, VistaShares has, a few of these that have either launched or are potentially coming soon. They have one with ticker OMAH that follows Warren Buffett's strategy, and then they have one ACI that follows Ackman's strategy. So if you look at OMAH, for instance, it replicates holdings disclosed quarterly by Berkshire Hathaway. I think it's a pretty interesting idea, and it does have some traction. But I think one of the big advantages here is transparency. You can piggyback on an idea by a manager that may not directly offer an ETF, which is an attractive proposition. But I think obviously the big disadvantage is the time lag. If you're investing in something based on some 13F filings, you may be up to a 45-day lag, and by then the trades may already be stale. So that's I think a huge disadvantage when we think of these sort of mimic or copycat ETFs.
Yeah, and I do wonder if, even though I know like OMAH has had a lot of success, and there are some other 13F replicator ETFs that have had success as well, I do wonder if end investors like the idea of having the quote unquote real thing, right? Having a Tom Lee actually manage the portfolio versus tracking 13Fs at a lag to mimic that portfolio. I think there is something there. I'm not trying to turn the conversation into Bitcoin ETFs, believe me, but it's kind of like, do you want futures-based Bitcoin ETFs or the spot, just as a crude example? And we know investors like the real thing. And I wonder if there's an element of that that's going on here. Before we move on, because I do want to talk closures, like, how do you typically view these ETFs in the context of a portfolio? And again, just like you were touching on, there are obviously some very different approaches here. But if you had to paint with a broad brush, how do you view these quote unquote Hollywood ETFs as part of a broader investment portfolio?
Yeah, I mean, in general, I would say they're not core holdings. They're not S&P 500 replacements, especially when you consider their fees. But I think they can be interesting satellite positions. There are ways for investors to express a view, or a way for advisors to engage clients that want that connection to a skilled star manager. Obviously there's some risks we mentioned. There's concentration, volatility, there's performance divergence when you're talking about some of those 13F mimics. But, for investors who understand those trade-offs, I think there's some excitement behind them, at least, when you're adding some diversification along the edges of your portfolio.
Do you think investors ultimately care about the higher fees here? Because, again, if you're getting a name brand manager and assuming the performance is here, I wonder if fee becomes very secondary. It's just not even something that is at the top of the due diligence list. What do you think about that on the fees?
Yeah, and I think that's a good point. I mean, it is a higher fee, but you are paying for the skill. So you could argue that, the fees aren't unreasonable on these. So, it may be sort of a secondary disadvantage when it comes to these.
Okay, so celebrity ETFs are clearly something that's hot in ETFs right now. Let's talk about what's not in ETFs. And probably the easiest way to do that is by looking at ETF closures, right? That'll tell us exactly what's not working. I guess first, I know you pulled some broader ETF closure data. Do you want to walk through that real quick, and then we can talk in more detail here?
Yeah, so I've been trying to follow this a little bit more closely because everyone talks about ETF launches, about all the new products we have, and all the various strategies. But there's this other side of it where we're seeing a lot of ETF closures happening. So far this year, just for perspective, we've had around 650 launches in the U.S. and we've had over 100 closures. So 2024, we saw a little bit less than 200 closures. It was about 190-ish that I saw. So we could see 2024 approach those levels. It's pretty interesting because you are seeing this mass of new strategies, and it's very exciting for investors and for the media. But then there's the more realistic side where you see a lot of these products close within a couple of years.
Yeah, there's a reason it's called the ETF Terror Dome, right? If you were to drill down into the types of ETFs that are closing, what most stands out to you? Do you see any obvious trends?
Yeah, so about 90% of the ETFs that closed this year are relatively newer. They launched within the past 5 years. Most of them launched either in 2024 or 2023. So recent, but not too recent. A lot of them are also equity funds, about 2/3 of them, but that's about in line with the proportion launched, so not very surprising there. When you look at median size, it's about 4 million, mean size is about 9 million. So you're looking at ones that are in the smaller end, ones that have sort of failed to gather some of those assets. And then I think if you drill down even deeper, you can see that a lot of these are actually thematic ETFs. They've been pretty hard hit. So if you look over recent times, there's actually been more thematic ETFs that have closed than have launched. And some of these are interesting trends, luxury goods, food technology, metaverse. I mean, they're interesting trends and they're unique, and I think they do have some potential and some demand. But I think there's not enough flows to go around, even though there are a lot of flows coming into ETFs. There's not enough to go into these sort of niche strategies. So the more niche and hype driven you see these funds, I think the more closure risk they actually carry.
I think, as you're well aware, the cost of actually filing for an ETF and then ultimately launching it has come down fairly substantially over the past several years. Do you think that's a factor here to where ETF issuers, they're much more comfortable, and I don't mean this in a derogatory way, but throwing stuff at the wall and seeing what sticks? Because why not? If it doesn't cost that much to bring an ETF to market initially, and you can see if maybe you catch lightning in a bottle, the risk return profile of doing that, it makes sense. And so maybe, we always talk, like I think about all these leveraged single stock ETFs coming to market. Why not? Because if you launch a bunch of those, all it takes is one home run, and it's worthwhile from a financial perspective, from the issuer's perspective. Do you think there's something to that?
Yeah, I mean, definitely. I think that's the nature of the ETF industry. It's all about innovation. It's all about the next new idea. And, like you said, why not? Why not? You never know until you actually try it, how successful it could be. So I do think we're seeing a lot of that. And I don't really think, that's a bad thing either. I think it's part of a healthy, competitive market to try out this new product innovation and sort of see where it goes. Because you never really know how it's going to catch on until you actually launch this product and put it in front of investors.
Well, and I think the other piece of this story, which I believe you and I have actually talked about in the past, is that obviously much of the core of a portfolio, that's spoken for in the ETF space, right? Nobody's launching another S&P 500 ETF, or I don't think they would, or another version of a value ETF, some sort of smart beta strategy. All that stuff is out there. And so what you're seeing are the types of products coming to market. They are innovative. but in some cases very esoteric and much more complex because you have to figure out how to differentiate in the ETF space if you're going to survive. And the reason why I bring that up, obviously, the more differentiated, the more unique a product is, I think the more difficult it is to find an audience for that product. It gets back to that catching lightning in a bottle, right? Because it's going to be something that is much more, I think in general, much more difficult for an investor to get their head around.
Yeah, and I definitely think you have that right.
Just a couple of minutes left here. So I'm going to try to pull our two topics together here. Bear with me. I think you'll like this. So let me ask you, do you think that there are some investment celebrities out there who they want to launch an ETF, okay, but they're scared of disclosure risk? Because that doesn't look so good. If someone is very well thought of in the investment world and they launch an ETF and it flops, whether because of performance or lack of investor interest or maybe both, I feel like that can hurt their brand, so to speak. So do you think that's a factor at all if I try to tie our two topics here together?
Yeah, no, I think that's a great point. I think you don't want your name tied to a fund that's going to fail to gather assets and then get shut down. I think that could really hurt your brand. And I think that's definitely a huge risk that has to be calculated when you're thinking about launching these products. I think the good news is, and we've talked about this earlier, is that, the ETF wrapper itself is strong. These closures, they're not really a weakness that has to do with ETFs. It's just signs of more healthy competition. But, nonetheless, that risk is part of that calculation. But, I think it's these two topics, they did tie well together because it tells sort of the same story about, the ETF market being competitive and about differentiation mattering. Some of these managers, they're able to lean into their personality and their brands and media attention to really stand out, while other funds, you see them disappear if they can't gain that same sort of investor interest. But, I think that's what makes ETFs such a dynamic and interesting market right now.
Yeah, I completely agree. And I'll just say, obviously, you have the transparency of the ETF wrapper. And if you are one of these quote unquote investment celebrities, you can't hide from your performance track record. You can't hide from, what you're buying and selling every day. And so let's say you are a prominent strategist, but maybe you haven't run a strategy before where you have that performance track record. There's some risk there. If you put that strategy out there and it doesn't do so well, that could blow up your media cachet, so to speak. But Roxanna, fun chat this week. I always enjoy visiting, so thank you for joining me.
Yeah, great chat, Nate. Thank you for having me.
That was Roxanna Islam, head of sector and industry research at VettaFi.
Trader designs ETFs for sophisticated investors looking for leverage on the daily, monthly, or quarterly performance on stocks and ETFs. Leveraged ETFs involve significant risks. Consider the investment objectives, risks, and charges and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information which should be read carefully before investing, visit our website at traderetfs.com.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Alex Morris, CEO of FM Investments, who currently offers 18 ETFs, about $8 billion in assets, though they're actually an $18 billion asset manager overall. But as I was noting at the top, this is an issuer who has been a real success story. So they pioneered the single bond ETF category with an ETF like T-bill, the FM US Treasury 3-month bill ETF. That's had a tremendous amount of investor interest. A few weeks ago, they launched two very innovative bond ETFs that are attempting to remove the tax drag of traditional bond ETFs. That's the FM Compoundr Core U.S. Aggregate Bond ETF, ticker CPAG, and the FM Compoundr U.S. High Yield ETF, ticker CPHY. And then not only that, FM is seeking to launch a mutual fund share class of their existing ETFs, a mutual fund share class. They're wanting to go in the opposite direction from many other fund companies. So they are clearly a unique issuer, and Alex is now joining me from Washington, D.C. Alex, it has been a while, but great having you back on the podcast.
Thanks for having me back, and thanks for taking the chance on us when we were just T-bill at a, $10-20 million, and you and I were sitting together in Kansas City in an ESPN studio, and you're probably wondering, who is this guy, and is he still going to be here next month? And to your point, $8 billion later, still going strong.
I'm going to go back and maybe I'm rewriting history, and I'm going to say I knew all along you had a huge hit on your hand, and you're going to be a tremendous success.
And we appreciated your enthusiasm for it.
All right, so I actually want to start with these Compoundr ETFs because just like with your single bond ETFs, I'm always intrigued anytime we see something new in the ETF space. And as I just mentioned, there are currently two of these. So there's an ag bond version and a high yield version. I'd love to have you start by just explaining these at a high level, and then we can certainly get into some more detail.
Sure. So, we tend to use the tagline for them, we fixed income. And in the fixed income world, right, you expect to get paid your coupon or some sort of periodic regular payment, which is great, except it has the problem of being taxed as ordinary capital gains. And in the case of some investors who are just going to reinvest that dividend anyway, why should we go through the hassle of doing this messy distribution process? We have to raise cash within the fund. We have to get it ready, distribute it to you. Depending upon your custodian, you might get it on a different day. Then you reinvest it either manually, which means you have to put on in the diary some time to do it, or you use it an auto reinvest like a drip, which doesn't always have the best execution price. All in an effort, by the way, to go back to where you started. So what if we could solve that? And Europe has actually solved this problem in the UCITS fund, where they have an accumulating share class, where this kind of happens naturally for you. 40 Act rules don't allow that necessarily. The ETF world hadn't created that, but we felt the need to do that. And it really came from our investors. We have a number of investors who told us, we love the yield on your products. We just don't want the distribution. We're giving you the money to invest. Keep it until we want it back. When we want it back, we'll sell. In particular, some cash investors who said, we don't really need the distribution. It's this messy process. And the larger the investor, the less they really wanted to do this. So we set out to make a product actually that we've filed. It's effective, called T-Big, where we were going to do just this thing in the cash market and also probably have a much larger than usual NAV to help folks who wanted to invest substantial amounts of cash but didn't want to pay penny per share levels. Along the way of trying to solve this problem for investors who want access to the bond market, want that actual yield in their portfolio, but want to defer receiving it until they're ready to sell, and in that case also defer their ordinary incomes for their long-term capital gains results. We met up with the folks who founded Claymore and built the Bullet Shares, had done a lot of other fixed income ETF innovation, and they pointed out maybe we should look well beyond just the cash markets and things that were highly yielding. And we looked at them with that sense of, oh, well, if you're so smart, what would you do? They said, I don't know. How about high yield bonds? You manage the ETF in that already and yields more than cash. It was one of those moments where slap yourself in the face, simple idea really came to fruition. So we teamed up. We had been building this exact product from the operational efficiency side and excellence side of the house. They had been thinking about it for a long while from the tax efficiency side. And when you put the two together, you get this great outcome. So the question, really comes to us, well, how do they work? And they work because ETFs can accrue their income, and you see that in the NAV and price. So if you watch, say, T-bill or any bond ETF throughout the month, you're going to watch it accrue its coupon or its accreted value until it pays its distribution. And then there's a sudden drop in the price of the ETF itself. So we buy that ETF. In the case of CPAG, we'll buy AGG as an example, and we'll own it. And just before it's about to have a dividend X date, we'll transfer into a security that's similar to AGG that has a different X date. So we avoid capturing that dividend. And there's some risk that we have to manage in finding an alternate that has really low tracking error. And the good news is we're really good at doing that. There's a lot of ways to do that. we built an index with NASDAQ so we could demystify this process. You can see it happening mechanically over time. You can see the list of alternates that we asked them to publish. It's rare that an index publishes not only what it did, but the things that it didn't do. So you can go and visit NASDAQ's website. You can see the alternates. And then in the high yield space, for example, we own two securities because we wanted to have a broader base of high yield to own. We might buy two alternates, but their size becomes an issue. So we start using some portfolio optimization to try to minimize your risk to the asset class during that window, right? Our goal is to provide you the experience of owning what that original ETF was as close as possible.
Okay, so I have several questions here. I guess first, in addition to avoiding the dividends and just the inherent tax efficiency of this strategy, my understanding is that there's some academic literature out there that would suggest this strategy could actually offer a little bit of outperformance. And the way that I would lay this out, Alex, is like my understanding is that investment holdings that are set to pay a dividend tend to increase a little more than expected in the lead up to that dividend payment, probably just because investors love income, right? And so they think they're getting something extra here. Do I have that correct, that there is at least, and I know that's not necessarily the reason for the strategy, so to speak, but maybe an ancillary benefit?
It certainly is. There's been a lot of interest in dividend capture strategies for a long time. And there's a lot of literature to point out that you can make money actually through the dividend by buying before, getting an increase of price, which also doesn't go away right when you sell. So we sort of pick up some of that buildup. We sell at more or less the peak of that buildup because our interest is to avoid the dividend altogether. And we'll then move that asset into something else and we'll rinse and repeat that strategy. And if you look at the track record of the indices we had NASDAQ built, again, in an effort to demystify the process, we wanted folks to realize it isn't alchemy. It isn't just active management trying to do its thing. There's an actual process that can be followed. There's a lot of vigilance that needs to be taken to execute the trades, right? It's not so simple as just put into machine, hit go, unfortunately. But that's why we have a team of folks who focus on these things. And so we do pick up some of that benefit. Also, some of the alternates during that window, because they're not undergoing these corporate actions, tend to have a slightly stronger performance track record. Some of that is elements of what you just pointed out. Some of it is just when there's a lot of cash sloshing around, you're out of the market a little bit. You've got a lot of other things going on. It tends to introduce some clunkiness. And every ETF issuer has to deal with clunkiness around distributions. We basically just sidestep that process and pick up tax efficiency, pick up some of the div seeking behavior where we can harvest some of that. Although it's not the pure intent, it is a nice benefit to have. And just some of the operational efficiency that comes with not preparing the portfolio to generate cash, hold on to that cash for a day or two, and then ultimately pay it out to shareholders.
You mentioned that you want to ensure that the ETFs that you're rotating into have low tracking error to the underlying asset class or index in this case. And I think, as you know, I always like to consider the full picture of any investment strategy. And I don't know if you would consider that a potential downside, but my question for you is, are there any other potential downsides to this strategy? Like, is it marginally higher transaction cost, or is there anything else that could be detrimental?
It's a good point. So anyone can look at tracking error and decide what to buy. Modern portfolio theory works in our favor here. Sometimes buying more than one thing actually reduces the net tracking error. So what feels like a deficit actually can be to our benefit. And, an example that we use outside of the fixed income world is, what if SPY paid a dividend different than the day of all of the X sector tractors of SPY? Well, we could actually perfectly replicate SPY. So why would you pick just the lowest tracking error of one sector when if you bought all of them, you could have tracking error effectively zero? So what I think folks look at is, well, there's some risk there. There's some, but it's manageable. This is, a lot of theory on the matter to help us do this. And, in many cases, we can actually do better than the single tracking error fund that you would see as an alternate by buying a basket of securities. And as the fund grows, and in time, you'll see us do more of that. Right now, we do a pretty good job of tracking the index with just the one or two that it might propose. There are, potentially some frictional costs of making some of these trades, right? And they're explicit, which I think is hard for people to understand sometimes. It's not that you're not paying those frictional costs and making those trades to pay the distribution. You're just not seeing them. because the NAV changes seem small, or you don't see the transaction costs explicitly, called out in the trades we're doing, but they're there anyway. So we'd argue for investors, you're at the same, item. The problem that probably comes in is, what if folks start changing their div dates to align them all? Well, then we have to find alternates that may be a less good fit, in which case that optimization strategy is good, that we've been working on it for the last 6-8 months, and we think we've got it tuned in nicely. Or we would just use our own funds or launch our own funds to help facilitate these sorts of trades. We were very consistent in our thinking, and it's with all of our products, and it's exactly what you said. Everything must first be a good investment before we make it an ETF. And there's a lot of ETFs that I'd argue that are, as Sumit just put it out from ETF.com, slop, to use his phrase. And that's not our game. We wanted to make sure that it was first a good investment. It would be a durable investment, unlike some of our treasury products where we expect there to be some high velocity of capital coming in and out because they're cash-like products. Here, the benefit is buying and holding for a long time. So we were deliberate and slow in our math and in our thinking that this isn't not just a good investment today, this will continue to be a good investment while you hold it for the next decade. And that took a lot of time and convincing internally. We're probably our own harshest and worst critics. Although that said, I've seen comments from others that may, YouTube and otherwise, that may let us know that we're not our own harshest critics, but we worked diligently to make sure of this. We didn't rush it out the door just as fast as we could. We wanted to make sure it didn't violate that cardinal rule. The cardinal rule is this must be a good investment before it has any of these other benefits.
Sort of on that note, my understanding, Alex, is that FM has filed for several other versions of this strategy, correct? There's a AAA CLO ETF, a 10-year Treasury version, among others. Do I have that right? I know you can only talk so much about live filings, but what's the strategy there?
So you're absolutely right. There are 4 others that we filed with simultaneously, and we'll intend to refile and make effective once these start to catch on, and we've had a lot of great press about them. But the idea is if it works for one part of the asset class, it works for all of them. The higher the cash pay rate or the greater the return that comes from taxable distribution, the better the compounding strategy within this ETF structure works. So you'll see other items like BDCs and REITs that tend to fit nicely into this space where investors love the overall yield, but dislike the taxable character of it, or are reinvesting anyway and would prefer just sidestep the mechanical, pas de deux that they have to do once a month, once a quarter to try to just get back to where they started, which, by the way, the transaction costs that they bear much higher than our own. The slippage that they have to endure is much greater than we get in the accounts trading institutionally.
When I think of the overall tax innovation in the ETF wrapper, if we just were to take a step back here, I'm curious if you have any concerns that Congress might at some point try to come in and go after this tax innovation we've seen in the ETF space. And I know it's been talked about before with in-kind creations and redemptions, right? People, closing the quote-unquote ETF tax loophole. That didn't really go anywhere, nor do I think it should have, but it was talked about, at least for a moment in time. But let's set that aside. We now have 351 exchanges. We have ETFs like your Compoundr products, and there are some other ones out there now on the equity side. There are box spread strategies. Do you think that this could show up on Congress's radar at some point?
Well, they're not that far from me at the moment, so I get a little view of what the radar is, and no doubt it's on the radar for some. But the ETF is the most powerful, innovative force to hit Main Street since perhaps the bank account. And I doubt highly it makes sense to go out of our way to take that benefit away from every investor, in particular Main Street retail investors who rely upon some of this for long-term asset allocation and other strategies, all in an effort to do what? What would we replace it with? And to your point, there have been efforts to close the in-kind, the 52B4 loophole, as it were, the 351, but none of these were loopholes. These were actually features of the code. These weren't created in the last 12 months to allow Compoundr or other strategies to work. These have been features of the 40 Act for many, many years. They're now just gaining more prominence. And indeed, that prominence does maybe bring some negative attention. but I don't know that there's a great lobby to want to change it. ETF investors are happy for it. Issuers who are providing products are generating innovation and making products more accessible to everyone, generally in a safer, more well-defined wrapper than some of the more traditional private opaque ones. So it seems like everyone is better off for it. But if Congress does need to go looking for capital, certainly this will come back up on the radar. Again, I don't know that there's a big lobby to want to change any of this, but we'll see. But it's sort of like the carried interest exemption. Every few years you hear about it, and that helps 0.1 of 0.1%, and every few years it just quietly goes away. Here, such a powerful force for so many, we'd have to replace it with something better. And I've not yet heard what the better is. Certainly the ETF was an innovation, not just on tax efficiency, but on operational efficiency, cost, availability versus its mutual fund cousin. I don't know that going back to that is going to necessarily help anyone when we have less transparency, less liquidity, less of a team sport where we get to spread the risk to the right players and deliver a better overall experience for investors, tall, small, retail, institutional, and all sizes and flavors in between.
Yeah, I agree with all that. Certainly when you talk about in-kind creations and redemptions, I think we would both agree that's a more fair outcome on the tax side for investors, right? If you're in a mutual fund and you have other shareholders that are selling because they need cash, that impacts the existing shareholders in the fund. The idea that you can defer taxes via the creation redemption mechanism in the ETFs, I think that allows investors to pay taxes when they sell, not when other investors sell. I just worry about with some of these other mechanisms, again, 351 exchanges and the box spread strategies, strategies like yours. I think we're going to see tremendous investor uptake, which I know you want to hear. I just wonder if with that tremendous investor uptake, again, this gets on the radar of some enterprising politician that wants to try to, move this up the flagpole. So we're going to need you in Washington, D.C. to really work your lobbying powers.
Well, it's funny you say that. I mean, that's part of the gig of being here. The attorney we've used, Aisha Hunt, who does some great work, particularly on our mutual fund share class application. She and I have been starting some lobbying efforts for other elements of the 40 Act that we think need some work. And certainly should this come up, we'll be ready to have those conversations. And I agree with you. I think to us, that's why we're very, very careful to make sure we're launching good investments first. We're worried about things that just feel like a tax dodge. The box spread strategies that use options and other things to generate treasury income seem to actually be in violation of if you're generating treasury income, you have to call it treasury income spirit, if not letter of the law. And I appreciate there's some tax opinions that sort of articulate otherwise, but there has to at some point be a fire break where we say, this is enough. The compounder just uses the in-kind creation redemption mechanisms and some timing that lots of other active managers have used for a long time. And so, like I said, it had to be a good investment first. There is some actual alpha that you're going to pick up from letting us doing that compounding for you and not asking us to generate negative alpha for the fund by being uninvested. But agreed, when these things become just about the taxes, then we start to invite trouble we don't really need. But in the long run, I think there is some actual tax planning that ETFs have done a great job with, and it makes sense for investors to have access to those tools. It's up to the government to come up with a fair overall taxation scheme to make this work for everyone. And they've seemed to struggle to do that in the last 4 or 5 years and well, probably the last 40 or 50 years anyway. So they'll continue to struggle and find a way to make ends meet or issue more debt, which is, sort of great news for T-bill and its series mates in the benchmark series, because we're there to help you take advantage of that too.
Yeah, and on that note, before we move on and talk about the multi-share class structure, any strong views on the fixed income markets right now? Because as you were just alluding to, FM does have a number of ETFs available here, a number of different solutions for investors. I'm just curious, is there anything in particular you think investors should be mindful of in the fixed income arena right now?
Sure. There's a lot happening. The lack of volatility in the bond market, we think, sort of masks the fact there is a lot going on. We have a assault on the independence of the Federal Reserve. We're a little upset. We were out of town, so we missed free Fed building tour day when the president decided to go check out a building site and seemed to be in his element. From some friends who were on that tour, we know that the president was in his element, and turns out there was a very interesting conversation around what type of wiring and piping we were getting. But we think that if we put all that in context for the bond market, which does take its cues from the Federal Reserve, threatening Jay Powell's job, trying to fire or semi-firing Lisa Cook, and trying to take over effectively the ability to hire and fire regional presidents at will and replace them with courtiers to the president is worrisome. The 30-year bond is up in yield. The 10-year is sort of flat to a little bit down, but it seems like we haven't heard the end of this yet. We will get rate cuts. We expect that to happen. But when that happens, we appreciate that mortgage rates go up. The long end of the curve may go up some. That said, if you've been in the T-bill market, you're still earning a lot. We think that's a great place. We've liked the credit space. Credit spreads were tight when we started talking about it. They've only gotten tighter. We know at some point that has to reverse, but you still need to think about taking a little more risk in that space, particularly as rates start to come down. You need to think about taking a little more duration risk, a little more credit risk. And there's some, nice products out there to help you do that. But on the whole, the bond market is really healthy, despite all of the noise and all of the naysaying and, some of the fetish for all of the doomsday scrolling that we like to have, that, this industry attracts. Things seem to be working pretty well. There are cracks in the real economy, but those cracks haven't come out totally yet. We've been talking about seeing little cracks for the last 6 months, 12 months, and they've yet to become these major fissures. And it's not like the cartoon side of the mountain has fallen off yet. We don't see that needing to happen. The Federal Reserve has done a great job at sort of pushing this through. Maybe rates were too high for too long, but we haven't seen the downfall of them staying high. We do know the risks of them going to zero too soon, as it were. We don't think they're going to zero. We think the new neutral rate is a natural rate is going to be a little bit higher than we're used to seeing. And after Jay Powell's tenure, the next guy's going to have some real trouble of how do you navigate this when you have obvious political pressures to drop rates, but real economic forces telling you they probably need to stay higher than anyone is used to or comfortable with in recent memory. But so far, the rest of the bond market, issuances are good, rates are reasonable, tight spreads are priced to perfection. It's hard to complain with what you see, but we do think there's that volatility that's being masked by some of the Fed's action, by some of the Treasury's actions. So you should be ready, particularly if there is, a change in Fed regime policy and full politicalization, which, may happen as soon as the next 6 to 8 weeks.
Is there something that could occur, and this is casting a wide net with this question, that would really make you concerned with the fixed income market? So you touched on a number of things there. I mean, is it, several extremely high inflation prints? Is it credit spreads all of a sudden starting to widen? Is it some really bad economic data coming in? And obviously, all of this can be interrelated, but or is it the Fed that you're talking about, a real shift in Fed policy? Like what would keep you up at night the most that could be out on the horizon?
Well, ironically, the thing that keeps me up the most of the night recently is the raccoon that's been eating my garbage and keeping the dog awake. But, I haven't worried much about the bond market because it has proven so resilient and healthy. I do think the catalyst for this in the short run is going to be the Fed and politicization of the Fed. Bond markets in general take their cues from what's happening at the Federal Reserve and interest rates. A strong set of inflation prints would probably just delay interest rate cuts that would be there. I don't know that they necessarily need to go up, but certainly the current regime in its current constituency has proven the ability to navigate that data very well, which is a hard opinion to sometimes defend, but it's a tough job to do where there's 360 million people with 365 million different opinions. So net, the results have been pretty good. Maybe a little higher than I would have liked to see for a little longer, but still so far so good. But if you change the constituency and you change the mission, and the mission now becomes just find a way to reduce rates, then all of those other things that were being managed well are no longer managed perhaps at all. Or the theory goes, they won't matter as long as we grow fast enough. And we just don't see the story for that growth. AI is great, and we see elements of that in the equity market and a lot of themes, but we look at our folks getting jobs. And right now the answer is yes, but the mix of who is not getting jobs has changed dramatically. A lot of the highest end service workers, right? Coders, folks who are coming from good schools, who are hoping to land that first job at $250,000 plus $1 million of stock that will vest over the next 5 years, are finding themselves out of work. Sort of obviously predictable trend when most of those coders are working on AI tools to replace themselves. But still, we notice that that's going to become a problem. So all of it comes back to, if the Fed Policy Committee can actually manage this effectively, the bond market's going to be just fine. All of a sudden, if that changes and we start to unhinge our policy from the economic reality, we keep firing folks who are putting out the stats as honestly and best as they can, then all bets are off. And that's where the bond market can go haywire. And we've seen elements of that during Liberation Day tariffs, where what backed the president off in the short run from some of those tariffs and to issue some extensions was the bond market not even going berserk or having issues, just flashing warning signs that this is coming. And the president backed off pretty quickly. We'd worry if some of these other things happen that we won't get the warning signs. We'll just get the actual action, and that would be, potentially disastrous. But the good news is the folks who are managing it understand this and have done a good job of navigating around some of those icebergs. But that doesn't mean you miss one in the near future.
Yeah, excellent overview of the fixed income markets, Alex. Look, just a few minutes left here. I want to make sure we do touch on this multi-share class filing. So as I noted earlier, FM is unique in that you are attempting to launch a mutual fund share class of your existing ETFs, where, of course, many other fund companies are trying to do the opposite. And so do you want to explain your rationale here?
Sure. It's Back to the Future. I hope I get to be Marty McFly in that, not Doc Brown. Don't have the hair for that one. But the ETF space has done a lot of great things in innovation that the mutual fund space has not been able to keep pace with. So we wanted to launch mutual fund share classes on top of ETFs because, one, we don't have big mutual fund business that needs an ETF share class. We have a couple of mutual funds that might benefit from it. But T-bill, R-bill, which is, the inflation protected short-term cash, the first ultra short tips ETF and only ultra short tips ETF out there for the time being, has no real access to some places who need it most, the retirement market. And there are a lot of investors who are just obligate or preferred mutual fund investors who need, and we argue should have access to innovations that we've made and that many, many others have made. On the other side, there's a lot of mutual fund investors who can't seem to make the switch, or issuers who are now forced to make this decision. Do I stick around with a suboptimum vehicle for what I want to achieve, this mutual fund, or do I risk trying to convert it, which has a lot of issues in getting shareholders who own funds directly with the TA to try to open brokerage accounts and cause a lot of disruption for my investors, which isn't my goal? Or I have to actually just create a clone fund, which many investors don't like because it's confusing. Investment platforms don't like, and they'll make you choose one or the other in many cases. So all the options there seem to be poor. The real option was, well, we're trying to manage the same strategy in these two different wrappers. They're both 40 Act wrappers. They're both trying to attract, a broad investment base. They have the same mandate. Why can't we just manage them as one fund and now just offer folks the right outcome to it? So we wanted to do that. For us, we just needed access to the retirement space, and folks in the retirement space called us all the time and said, hey, could you offer a mutual fund version of what you're doing? And then looking beyond just mutual fund ETF share classes, we think there's a lot of opportunity for VITs, CITs, other features to have pooled investments all in one place. Because ultimately, investors want what strategy that we're trying to execute. They need it in a wrapper to fit some other set of rules or some investment mandate that they have, but they want the difference between those to be effectively zero. This is the best way for us to provide that. On the other side, there's some cool benefits of things that mutual funds do that ETFs can't do. There are some tricks that they have up their sleeves around how they're created and redeemed, and how they can have different share classes that ETFs have never really been able to crack the code on. So this, I think, will give us an opportunity to bring some of the good of mutual funds, and not that I thought they were ever going away, but certainly a renewed opportunity to stick around a while longer and teach those tricks to the ETF, but also use some of the transparency and the simplicity and the sort of distributed risk sharing that ETFs have and bring them to the mutual fund investor now today, but without them having to change what they're doing, or without having to change vehicles, or without a lot of disruption to their general portfolio, which ultimately we think is important. We want to provide more choice, more benefit, but less disruption, less confusion. And ironically enough, the confusion of offering these two different share classes actually achieves that investor outcome of simplicity much better.
And where does this all stand right now? Obviously, nobody knows for sure what the SEC might do or when they might do it, but I would say there's certainly a strong level of optimism out there. What's the status of your filing, and any idea on an approval timeframe?
So certainly there's a lot of industry momentum for this. And the SEC, I think, glommed onto that earlier in the year, and we heard a handful of commissioners and deputy commissioners talk about it. We made a lot of progress. You've seen us make some updated filings. There's been a lull recently. The SEC has been focused on crypto and other matters, and we expect there to be some extensions in this case. We never thought this was going to be a one and done sort of opportunity. We always felt this was a nearer the end of the year Q4 initiative that would start to come to fruition in Q4 and Q1 of next year. Still feel that's a fair timeline. There's a lot of investor benefit that comes from this, but it's really an industry-led initiative. This isn't a commission-led initiative. They have other priorities from the administration they've been working on, but issuers and investors increasingly are asking for this, and the staff has done a good job of balancing all of those forces. But there are some actual practical implications that come along with doing this, and they need to thoughtfully consider them and make sure that most of what the investors are looking for is preserved, but in a way that's safe and deliverable and repeatable. Let's not forget, most ETF innovation happened after 2017 when 6C11 came out. The sort of Cambrian explosion of ETF ideas made possible by this rulemaking process that was otherwise anodyne and arcane, but really necessary to allowing ETFs to be what we know them to be today. That same thoughtfulness needs to go into unlocking these share classes and now taking two things that have been segregated for a long time and building the bridge between the two. So we appreciate the thoughtfulness of that. We've had many conversations with the SEC through letters, in person, in their office, and we know they're taking time, care, and vigilance to do this well. But it can't be rushed. And even if it could be rushed some more, there are other priorities, and we appreciate that. But we really want this to be done and done well, not just done now.
Before I let you go, you just mentioned investors being interested in this. And I'll tell you, I've asked this question of pretty much everyone I've discussed the multi-share class structure with. So I'll ask you as well to close our conversation here. How big of a deal do you think this will be for the asset management industry overall? Whether we're talking ETF share classes of mutual funds or vice versa, like you're doing, how big of a deal could this be?
I think it's going to be massive, but I want to caveat that with, it won't be massive day one. This is the kind of thing that a lot of folks have filed for, right? 70 plus different issuers representing thousands of funds that are now filed that might have the benefit of this relief when it is granted, should it be granted. But not everyone's going to jump into that space right at the outset. It is tricky. How you manage a mutual fund is substantially different than how you manage an ETF. If you're a legacy mutual fund provider, just jumping into the ETF market sounds easy because now you have a share class, but it requires a capital markets team and investment. It requires a handful of other ways of thinking about managing your portfolio, particularly in the actively managed space, how quickly you can make those changes, what that communication coordination is like. Transparency goes from 4 times a year on a delay to now every day in real time. So are these considerations? In the long run, I think this becomes a massive change that helps investors freely move between share classes, freely move between investments, and without some of the implications that they have today. But it's going to take some time to get there. I think we're also going to find some unintended consequences that are good for investors, different ways to create shares, different ways to participate in the market, lots of other ways to sort of gain exposure that you want or maintain an exposure that you want without the hassle that you experience today in some of the buy-sell transactions or bad decisions being made because of tax implications. But it's going to take a while for investors to see that. It's going to take a while for platforms to provide a unified experience, right? You're not going to see the convert mutual fund ETF button pop up on your custodian the day after this is released. And for us, we think it's important that the industry get together and find a way to do this in 1 or 2 paradigms consistently. Because the thing that will make this great innovation and capability and squander all of its outcome is very much if we make it too confusing, too different, too difficult, and no one can understand. And as an industry, we have a bad habit of overcomplicating the things that should be simple and underthinking the things that should be simple and assuming they just always work. This one needs to be done right, and we think folks are taking the time and energy to do it well.
Very well said. Couldn't have said it better myself. Alex, best of luck on this mutual fund share class initiative. I just can't wait to see how this all plays out. But best of luck on that. Congratulations on the new ETF launches as well, and really the success of your ETF lineup overall. I love seeing it. Thank you for joining me this week.
Thank you. Thanks for having me back.
That was Alex Morris, CEO of FM Investments. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute's Certified ETF Advisor Program. You can learn more at cetf.org. Two excellent guests for you next week. I'll be joined by Ben Fulton, CEO of Webb's Investments. So they have a very interesting lineup of what they call defined volatility ETFs. And then I'll also be joined by Arthur Nowak, Client Portfolio Manager at Alger. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.